All right, welcome to chapter 12. This is a critical chapter for us in this particular course because we're finally talking about venture capital. And we're talking about it from the standpoint of the industry, the economics of the firm that is the venture capital firm, and then go into one of the most important documents we're going to see in entrepreneurial finance, which is the term sheet, and then illustrate the power of that term sheet with different scenarios that show who gets the money under those scenarios. So hang on to your hats and pay attention because this is a core part of this entire course. So we're going to cover the U.S. capital markets and how venture capital fits into it in context of government programs and private venture programs. Then we're going to look at the business model for the venture capital firm. How do they make money? How do they get money? How does that all work? And then look at the relationship between the venture capital and their limited partnership, their sources of money. And look at the process by which they do their funding. If you're an entrepreneur, you need to know how they do their business and why so that you can move along with them and show the credibility that you've done your homework and that you deserve to be financed by them. Then we'll look at the term sheet. We'll take one example term sheet, look at the technical provisions, some of which are legal, some financial, and they're all important. So we'll look at it. It's only 2 pages, but there's a lot in those 2 pages. And finally, we'll then say what happens if we do the funding, and now it's time to liquefy the investment in a mergers and acquisition scenario. Who gets how much money? And we'll show how the term sheet then is operationalized when it comes time to split the money. All right, first objective is a little background on the venture capital business. So the top section looks at U.S. government programs, and the bottom is the private markets. In the U.S. government side, first we have to understand something I don't think most people realize is that our economy in the United States is driven not by large corporations, it's actually driven by small business. And the government knows that, so they create programs to facilitate the creation and growth and continued success of small businesses. And we see this throughout law and in different tax codes and different subsidies that occur for small business development. There are 2 main areas for the U.S. government to provide assistance, and they're usually carried out through some government agencies, notably the Small Business Administration, called the SBA. One of the main things they do is provide loan guarantees. We've already talked about how corporations, when they go to a bank, if they're not really well established yet, the bank may not be very anxious to provide that loan without some pretty heavy collateral or other loan assurances. So how does the U.S. government assist that? They do something called a loan guarantee. Rather than the government make loans directly to small businesses, they empower banks who want to participate in this program to originate the loan. Now, the trick to it is that if a bank gave the loan and it's 100% owned by the bank, they have 100% of the risk. But what if the U.S. government says, you make that loan and the top portion, the first dollars that you lose on that loan, we will cover as U.S. government. All of a sudden, there's more assurance to the bank and therefore lower risk that they're going to get their money back. And even in a bad scenarios, they would not bear the brunt of the entire loss. So that's called the SBA loan programs. And the commercial banks make the loans to you, the small business person, and behind the scenes, they work with the government to get what they need to get to make the loan make sense from a business standpoint to the commercial bank. The second is through an equity program, and these are called SBIC or MESBICs in the case of minority enterprise, small business investment corporations. And these do investments that are done through private organizations, corporations that are investment companies. And instead of doing a loan guarantee, as in the SBA loan, the SBA gives financing through stock. So they will purchase preferred stock in this private investment company, and therefore the preferred stock gives capital to the SBIC, which they can then use along with their own capital to invest in small businesses. So once again, the government is not making direct investments in this case, stock investments in small businesses. They are supplementing the capital and therefore lowering the risk and increasing the return to private organizations that are in the business of making investments. So those are called SBIC loans and sometimes called MESBICs for minority enterprise to suit other social objectives of the program. All right, so now let's look at the private side. And here is the purview of the venture capitalists. So they sit here and they get money from investors, and then they make the investments in the promising ventures. And that's what we're going to look at today much more closely, is how does the venture capital industry work? and how does one get money from them and form a good working relationship with venture capitalists. So as mentioned, we have U.S. venture capital from U.S. SBA and SBIC. Those are government-supported programs. And the VC firms are, a lot of people think that VC firms invest all their own money, but it's actually not. They may act like it because they treat it as if it's their money. But typically, the vast majority of the funds that are in the investment pool that is used by VCs is provided by outside capital.